Hey, this is Chris, and in this video I'm going to be answering the question we get quite often at StockSpot, which is the market overvalued? It's something I think people are often worried about, especially after markets have had a good run of performance, as they have recently. Now, the first point I want to make is that overvalued and undervalued are very subjective measures. There isn't any sort of rule around whether markets are overvalued or undervalued, and really your thinking on that is probably determined by your own variables. And your own assumptions that you're using. So your assumptions around growth rates, around earnings, around dividends and other factors determines whether you think the markets are overvalued or undervalued, and these can be different for different people. That said, there are a few kind of broader measures you can use to determine whether markets are wildly overvalued, and I'm going to be talking about two of them. So the first one is looking at recent returns versus long-term averages. The theory is that if markets have had very, very high recent returns compared to their long-term averages, then maybe they've got ahead of themselves and there's going to be a period of mean reversion as returns come back down. Now, what we see at the moment in Australia is that the returns over the last 5 years in Australia has been only around 6.2% per year, and that includes dividends. Now, that's actually quite low compared to the long-term returns in Australia, which have been around 8.9% per year, including dividends over 30 years. So based on that measure, Australian shares haven't actually had a wild period of great performance. And in fact, the share market in Australia is still below the level it was before the financial crisis, if you exclude dividends. So we haven't seen a wild period of exuberance, and therefore, by that measure at least, the market isn't overvalued. The other more technical way of looking whether the market's overvalued is looking at what's known as the equity risk premium. So basically, this is a way of measuring what extra compensation people that are investing in shares demand over putting their money in the bank. The idea is when that risk premium is low, people are pretty excited and wild about markets and they don't need a lot of extra compensation to invest in shares. And when that risk premium is high, it means people are fearful and therefore need more compensation to invest in shares. Now, to give an example of when the market was at least retrospectively overvalued, at the end of 2007, just before the financial crisis hit, the equity risk premium in Australia was 2.8%, which means that above what you could get in the bank, the people investing in shares were happy to just receive 2.8% per year in both dividends and capital returns or earnings growth combined, which isn't very much. And as it turns out, markets fell a long way after that. Compare that to now, where the equity risk premium in Australia is around 4.5%. That's actually relatively high compared to history and means that people do demand quite a bit of compensation to invest in shares, and therefore the market based on that measure isn't overvalued. So overall, what I'd say is that it is hard to work out whether the market is overvalued or undervalued, and periods where markets are overvalued based on different measures can last a long time. So even if you do think the market is overvalued, it's pretty useless information on its own because markets can stay overvalued for years or even decades. However, that said, based on a couple of measures, recent returns and the equity risk premium, Australian shares aren't overvalued at the moment.